Okay, so the last video for this section on bonds, and then we'll go into stocks. So remember, bonds are a security that are sold in markets, and they're sold at a market price that reflects the value that investors place on the stream of future cash flows. And sort of imputed in that, or implied in that, is what is the level of risk in the cash flow. And individual investors don't need to make their own decisions about the riskiness of bond issues. There are bond rating agencies. 3 of them are very well known: Moody's, Standard & Poor's, and Fitch. And they produce ratings which signal to investors the likelihood of default on the bond, on the loan. And the rating scheme, it's a little bit different between each of them. They go, the highest is AAA, and then they go down into the B range, and then once you get below BBB minus, they call it. It's kind of like Keene State's grading scheme, right? It's an AB. When you get going down into the B range, then you are looking at what are called junk bonds, which are also known as speculative grade bonds. So the way that these rating agencies do their work, and they just gather up all the information that they possibly can about a company or a government entity. They look at the economic trends going on in the industry, in the economy in general, and they assign a rating. And what we can do is look at, bond ratings for different companies. So Moody's is giving Nike an A1 rating, right? There it is, A1 here. So high credit, but not the very, very top. How about we look at another one? State of New Hampshire. Okay, the state of New Hampshire bond rating, AA plus, right? AA plus, A1A or AA. Okay, so that's good news. How about bond rating for the state of Michigan? Okay, Michigan is also given a good AA, AA1 rating. Okay, so these different states can have bond ratings, kind of like a credit score, right? How about a bond rating for Pier 1 imports? And we see that if we look at, say, a Pier 1, right, Moody's can single-handedly downgrade the bonds, and this is an article from January 2020. So they've got term loan maturity ongoing losses. So they went from CAA3 to CA. So that's all the way down here in its speculative bonds. Here, right? So extremely speculative. And of course, what do we know has happened to Pier 1 since? They've gone bankrupt and closed many stores. So the rating agencies, they are part of sort of the babysitters, I guess you'd say, for how companies are doing. And they signal the markets by issuing ratings for the bonds. And then the last thing that I want to hit in this chapter, just very briefly, is the fact that now there are 3 different rating agencies that your book mentions. One is Fitch, which is a British bond rating agency, Moody's, which is in New York, and Standard & Poor's, which rates not only bonds but other things too, and it also, of course, indexes the stock market. So these are your bond rating agencies and a little bit about how they operate. So the last thing that I want to just briefly address are government bonds. Both the federal government and state governments issue bonds of various types. There's muni bonds, which are issued by municipalities to pay for, roads and bridges and schools. States also issue bonds, and then the U.S. government issues a couple of different kinds. Notably, right, you use a different word to refer to each kind. So Treasury notes have maturities between 2 and 10 years. Treasury bonds, right, those are longer term bonds, U.S. savings bonds, right? These are maturities of more than 10 years. And then a T-bill is a short-term borrowing instrument with a maturity of less than a year. Okay, you can get 4-week T-bills, 3-month T-bills, 6 months, and a year T-bills. And that's basically how the government raises money to do what it needs to do. And the question of U.S. government bonds is a huge, huge, huge subject. We can discuss it if anybody's interested, but I'm just kind of going to leave it at that for now, because we could just go on and on and on and on and on about investments, and this module is already getting pretty big. Okay, so we're going to leave Chapter 6 here and move on to just talk a little bit about stocks, but not do the whole of Chapter 7. Okay.